Welcome to tonight's live stream where we are here to discuss the second half outlook. With me, of course, is Charles Scavone, our Director of Investments, and Chris Paris, our Chief Investment Officer. And it has been a wild start to the year. You know, we do every single year, we do our first half market outlook, and we do it at Hotel Zaza right around the corner for clients. And we typically have about 100 people in the room. And we always talk about the game plan, but we also talk about how important it is to have structure and to have a process that allows you to change and be flexible because investing in public markets is dynamic. You know, if only it were as easy as to have the game plan, put it on autopilot, and not worry about any curveballs kind of coming our way. But this year, we had curveballs. We not only had curveballs, we had sliders, we had knucklers. We had a very, very interesting first half of the year. So what we're going to do tonight is for about the first 10 minutes, we're going to recap not only some of the what happened in the first half of this year and how it impacted the stock market and possibly the bond market, but we're going to talk about some of the opportunities that were created and how important it is here at Oak Harvest to have this process-driven approach that allows for the flexibility to make changes when we do get these curveballs. And then, of course, we're going to spend the remainder of tonight's live stream discussing the second half of 2025, what curveballs may possibly come our way, how are we positioned, what do we think may happen, and also, what do we do to be defensive in case things don't necessarily go the way that we currently have the game plan set. So with that, Chris, how you doing tonight?
Doing good, Troy. Thanks.
We have our new setup here. So I see Drewski has joined us already. Drewski, thanks for being with us again tonight. I think you've been to maybe every single live stream that we've had. Couple of things that we're going to do, Charles, before I kind of get over to you. I often forget the ground rules, so I want to make sure I go over those. We are going to have two raffles tonight. So one will be in about 30 minutes, and another one will be at the end of tonight's live stream. So you should see a QR code at some point come across your screen. And if you sign up for the raffle, you are going to receive our Retirement Success Plan ebook. And also, you're going to sign up to receive our weekly stock market updates. And I believe the team, Chris, you lead this primarily, but the team works together to put these weekly updates out. Very short, very concise, and very impactful as far as what's going on in the markets and what you need to know. So sign up for the raffle. We're going to do two of those, and you will, if you win the raffle, you'll get a $100 gift card to your favorite restaurant. Our marketing department will reach out to you. Charles, how are you doing? We haven't done this in a couple of months. We've done some financial planning live streams. How are you doing?
I'm good. I was just thinking about your introductory comments, and I feel as though we gave our outlook for the year, and it feels like we've already been through two market cycles in that half year. And then the other thing that struck me, no pun intended, but it seems as though your analogy regarding curveballs and knuckleballs and stuff, I think we got hit by the pitch. We had to adjust without both teams, without a dugout clearing brawl.
Well, you know, when you get hit by the pitch, it's important to come in to that next go around, that next at bat, and stay in the box and try to make good contact.
So. Yeah, I like it.
Troy, when we were planning to come in here, and now that you're talking about sports analogy, I was thinking the first half we had our outlook, right, and it was if we had the outlook of, we had Donald Trump as the president once before, so we said, okay, this is the game plan. We know what he likes to do. We know what he wants to do. We know what he did the first time. Let's go with that playbook. And instead of Donald Trump and the president running the policies of the first half, which was 2017, low taxes, deregulation, he skipped the good stuff and he went straight to the second half, which was 2018, which was tariffs and friction and more regulatory environment, and that's what hit the market. So kind of got our playbook reversed, got tripped up there at the beginning, but with the process that we have in place that Troy and Charles talk about all the time, we were able to adjust, and the returns and the models are, I think, pretty good so far. Can I say that? Pretty good. That's not too precise, and we're having a good year.
Well, I think most importantly, having a flexible process allows you to take advantage of the opportunities that present themselves, because there is no certainty when it comes to which direction the markets may go, and these things that transpire throughout the course of the year, they cause upheavals. And as an investment manager, you have to be nimble. You have to be able to take advantage of those opportunities as they present themselves. And I feel like you guys have really done a good job as far as following the process and where opportunity presents itself, being aggressive, and then of course when it's time to be defensive, taking a more defensive stance.
Yeah, well, take a step back and let's kind of walk through that a little bit, step through it. And the thing that we've always said is that, what we try and bring is an institutional mindset to the investment management process. And this is from back when Chris and I and Dwayne and our team have this institutional background. And so really our North Star is always a thoughtful, disciplined, process-driven approach that you can rely upon to carry you through these periods when times are both good and bad. And without that, you're like, shooting the arrow without the feather on the back, and you're all over the place.
You're out in the sea with no navigational compass.
There you go. We're full of metaphors tonight. This is good. We're gonna start mixing our metaphors. But the thing that to keep in mind as well, and I'm not sort of talking out of both sides of my mouth at all, is to say that it's a very disciplined approach. But keep in mind, capital markets are dynamic, so your investment process needs to be dynamic as well. And that is, in essence, how we view this idea of active management. When things go awry, all stocks trade together as a basket because your index fund is selling every stock within the index, that affords a good active manager the opportunity to discern what are these attributes? What do we know, as much as we can know anything, the factors that drive corporate profitability, which drives stock performance over time. We can fall back upon that and be very selective and be active and proactive in what we do when others are acting under duress.
And when we have something like Liberation Day, when the S&P is down roughly 10% in a couple of days, I think the NASDAQ was down 12. Chris, as an active manager, what type of opportunities does that create for you as an investment manager on behalf of our clients? And also just generally speaking, that's a lot of times the baby's getting thrown out with the bathwater, right?
For sure, for sure. At that point in time, back in early April, late March, there was margin selling by leveraged players, basically forced liquidations, right? Some institutional players being told, you have to sell, you have to get off margin, and they have to sell everything, right? They can't choose to sell whatever they want, they sell everything. And our funds are not marginable for clients, and we run them, broadly in diversification. So it gives us opportunity if we think, technology stocks are undervalued and have good fundamentals going forward, and they've gotten down to levels that we find attractive, we can step in and buy them while other people are being forced to, regardless of whether they want to or not.
I think perhaps the other thing that comes into play as well is all of our client-facing advisors that can help guide a client and explain to them why they shouldn't make a bad, emotionally driven choice. Whereas it's so easy for most people, if just 1-800-REDEEM, where you say, now it's a click, right?
Yeah.
It's not at 1-800, I'm aging myself. But it's, it's click and redeem. But here, right, we have a stickier, what we would call a stickier client base that understands how their plan's built, have a longer term horizon. That also provides us an advantage because we know that the funds that we manage aren't going to be liquidated, and then we would be put in a position as the fund manager to have to sell securities. So that gives us a nice advantage as well.
That's one of the things unique here at Oak Harvest Financial Group. I consider it unique, is that when we have you guys in the investment department, you're solely focused on the investment management. You're listening to conference calls, you're paying attention to the markets, you're at the Bloomberg terminal. You're doing all the things that investment managers should do. And I did a live event today, and at the event, one of the questions came up that, Troy, what's the difference between the advisors and how do they manage investments and so on? Our advisors don't manage investments here, so our advisors are planners. This is one of the big differences of Oak Harvest Financial Group, is that we have financial planners, we have retirement planners that work with you, what's important to you, the tax plan, the income plan, and then they utilize the strategies that the investment team that you guys develop, taking advantage of the opportunities that are out there, to customize an investment plan based on your risk tolerance, based on your income needs, your time horizon, all of the things that make an investment strategy in your best interest. But most importantly, not just having the investment plan in isolation in a silo all by itself, but having that investment plan working with the income plan, Social Security, working with the tax plan, the health care, the estate plan, all of that working together. And I love doing these with you guys, these live streams, but I also love doing them with Nicole and Ryan and Eric and Lizzie and all of the advisors that do financial planning here. And personally, I just love the perspective of everyone and how it kind of all blends together into one final product for our clients, to where we can have the investment management team solely focused on what they see happening in capital markets, and then having the advisors understanding our clients' objectives and what's important to them and what they're trying to accomplish, and then using those tools inside of those plans to hopefully bring it all together to create the synergy of effort that creates what I hope to be is a better outcome for the client. And so having this conversation tonight about opportunity, for me, it's not just about opportunities in the market, but it's how do our advisors use what you guys talk about, what you guys do on the investment team, as an opportunity within people's financial plans to help them have more income, pay less taxes, and really just have a better overall retirement. So a little bit of a tangent for me. I'm going to get back on focus here. I want to say hello to a few people here that are chiming in. So Marilyn, from Fort Worth, Texas, thank you for joining us tonight. We have Mary from San Antonio. We have Maria from Virginia. Scott from Pearland. Zach says sit closer to the mic. Eric, I told you about these mics. If anyone else has trouble hearing Charles or Chris or myself, let me know. But I do feel confident in our sound team. I think we've figured this out tonight. This is a new setting, though, guys. How do you feel in the new setting?
I'm liking it so far. I feel like, like it's the podcast look, right?
Yeah.
So
yeah, it's a new setting. I like it, Corinne. Mike from Texas. We have Michael here from Vancouver. Oh, Vancouver. Hey, and you're a client. Oh, Michelle. I'm sorry, Michelle. I was in Whistler 2023 Christmas. Absolutely beautiful up there. Okay, so guys, we want to make this interactive. So I saw one question up here, and it kind of ties into our active management, but let me remind you of a couple things. One, we're going to have a raffle. You have a QR code that'll come up. You are going to receive our Retirement Success Plan ebook, and also start to receive our weekly stock market updates. If you sign up for the raffle, it's a $100 gift card to your favorite restaurant. If you win, we're going to do 2 of those tonight. And then the second thing is we want to make this interactive. We want to answer your questions. So the first one we have is from Luis here. Luis, thanks for tuning in. Not going to get into the specifics here of what he's asking, because he says, what is the outlook of Chinese companies being delisted? Can they be trusted since they're not held to the same standard as a U.S. company? And as active managers, this isn't a situation to where if we want to invest in Chinese companies, this is where we're going to buy the index, right? This is where we're going to allocate to an ETF. So just talk a little bit about the difference between active management, what we do here, and then if we want to have exposure to China or anywhere in Asia or possibly Europe or anywhere else in the world or any sector, the difference between active management and then sector allocation or geographic allocation to take advantage of opportunities.
Yeah. So it's a good question. So as a fund manager, you can easily gain access to a particular sector easily through a sector ETF, very liquid instrument backed by the underlying securities, and something changes in the world overnight and you want to allocate 5% to energy, right? Well, you can buy that energy ETF in one trade and then take a more thoughtful approach to reallocating that 5% to individual names that you may want to own that fit our investment criteria. So it becomes a 2-step process where the sector change can be made quickly and efficiently, but then the thoughtful approach to managing it into those individual positions. So you buy 5% in the energy ETF, and then you buy 1% positions in your names, individual names that you think are the best.
It's a great point. So Chris, so if we want to allocate to it, and he's talking about China, for example.
Yeah,
so,
same thing would hold, yeah.
So China, energy, whatever it may be. So immediately we want to get, let's say, Chinese exposure, or we want to get energy exposure, for your example, Charles. You can immediately buy that sector.
Yep.
But that ETF or that index, I guess ETF, may include, 40, 50, 100, 200 different companies, and you don't want exposure to all of those. So from the active management standpoint, we can walk every single company, we can do this immediately, through our SMR process, sales, margins, return on invested capital, and identify the companies that we feel within that industry, the energy industry, have the sales that are increasing the most, have the profits that are increasing the most, the margins, I should say, that are increasing, and as well as return on invested capital, ROIC. This is a metric that we can immediately identify and say, hey, Chris, instead of owning every single company in that ETF, all 50, let's find the top 5 that have growing sales, increasing margins, and expanding return on invested capital.
Yeah, I mean, you guys nailed it. As far as the question on the Chinese stocks, I mean, I'm going to answer what I know about it. The delisting, it's a risk, but delisting of Chinese companies doesn't mean you couldn't trade them, right? There are already companies Chinese that are not listed on the exchanges here. They're traded on the pink sheets. I think BYD, might be one of the largest EV makers in the world. I think it's a pink sheet stock that trades a lot here. So, if you couldn't trade it on the NASDAQ, I'm sure you can still trade it electronically on pink sheets and stuff. And it would cause a reduction in demand short term, but markets are global. They trade 24/7, most places, and not something we're overly concerned with. We do have a little bit of exposure to some Chinese-oriented names because they trade at valuations much less than the United States because of their accounting, because their growth is slower, but they are starting to accelerate, much like ours did a year ago, largely in the AI area.
Okay, guys, so we're going to transition now to the second half outlook. Done a bit of a recap here as far as not just Oak Harvest, our process, and how we were able to take advantage of some opportunities that presented themselves with the curveballs that we had thrown our way. But looking forward to the second half of 2025, I think we have to start with Israel and Iran. So I heard a few people talking at the live event that I did today, and we've got some questions from clients, and they primarily center around two things: oil and the equity markets, the stock market. So Israel has been bombing Iran. We bombed their nuclear sites, and the stock market has gone up, oil has gone down, and I think a lot of people have questions. That's kind of counterintuitive. A lot of people, I believe, think that if this were to happen, if we were to poll our clients, the general public, prior to any of these events occurring, I think 70, 80%, maybe more, would have said the markets would react negatively, oil prices would go through the roof, and none of that has come to fruition. So, Chris, what's going on?
Yeah, thanks, Troy. I think most of our client base would have thought oil would go up dramatically, like it did in the 70s. But you have to remember that I think energy is now only 3% of the GDP in the United States. We only get 3% of our oil goes through the Strait of Hormuz. The rest of it comes from domestic, comes from Mexico, comes from Canada. So, we bombed the Iranian nuclear sites. We were not looking to bomb oil facilities. We were not looking to bomb military outside of the nuclear not waste, the nuclear fuel that they were trying to make into bomb grade uranium. So, Donald Trump, with the heavy hand, looks like he might have been able to stop some of the fighting there between Israel and Iran. And you have to remember, they've been fighting each other for 2,000 plus years, right? This has been going on in the Middle East for hundreds of years. If it resulted in something nuclear down the road, the story would be very different. But right now, it seems to be a very short-term event. It's being de-escalated quickly, and the markets are moving on to, is the economy growing? Is inflation coming down here in the United States? Do people have jobs? Are the tariffs going to be lower than we thought? Those kind of things for the second half.
Insight, Charles?
Yeah, so keep in mind that, capital markets are always forward-looking. So they're not necessarily looking at what's happening immediately. And if you put that in context, you go back and say, well, Israel had done a pretty effective job of eliminating all of the parties associated that were supported by the Iranians that could create havoc within the oil-producing regions, and they had already been weakened considerably. And then when you go in and create sort of presumably this final blow, and it's not directly to the oil-producing facilities, then that sends a message. And the message was sent most clearly when the retaliatory efforts by the Iranians were more symbolic than anything else, and they didn't destroy their own oil production facilities like the Iraqis did back during that conflict. So, it does seem a little bit counterintuitive, and even some of the analysts on Wall Street that are supposed to be so, knowledgeable on all this had forecasts for $120 a barrel oil and all that, and it makes for interesting talking points, but certainly longer term, when you think about it, if you can remove what was perceived anyways as a very realistic nuclear threat to the world, if you can remove that, then have you raised volatility? No, you've lowered it, right? So you have a more solid platform geopolitically to operate from.
And I think it goes back to our process, honestly. When you say only 3% of our oil goes through the Strait of Hormuz, and stocks look at profitability.
Mm-hmm.
And when we discuss our process, which is based on identifying companies that have increasing sales, expanding margins, and improving return on invested capital, when oil represents such a small portion of that overall formula, and you understand that, it's not a surprise that it doesn't impact the math to a great extent. And I don't know what those Wall Street analysts that were claiming $120 a barrel, maybe they shouldn't have a job anymore. Or maybe they're just on that side of the transaction to where they benefit from that information. But it doesn't make a lot of sense. But why is it, and I guess maybe this is more hypothetical and maybe not appropriate for our discussion, but just curious, why is it, do you think, propped up so that if something like this happens, Armageddon's going to take place, the stock market's going to tank, and here we are, Israel's been bombing Iran, we bombed Iran's nuclear sites, and the market's up 3% since this happened, somewhere in that range, the S&P 500, maybe 4%.
Right. You've removed the uncertainty.
Right. The cost of insurance for the time period already had some kind of event in it, right? And since the event wasn't as bad as people expect, people exhale and the markets lift. Because fundamentals domestically here in the United States are okay, right? They're still okay. Earnings are still growing overall. The economy is still chugging along.
Okay, so the markets were afraid of this ultimately happening, and when it transpired, that it could be much worse than it actually was. So the market takes a breath and it says, hey, you know what? We've diminished the Iranian nuclear threat. We have created a more stable world environment, and we're going to move forward and focus on what we always focus on in equity markets, which is increasing sales, expanding margins, and return on invested capital.
We would have highlighted, geopolitical risk as a large risk, and it always exists, but it ebbs and flows, and you sort of reach a bit of an apex, and now it's deflated. But what happens there maybe reduces geopolitical risk, and there might not be military retribution, but now I think people will start talking about cyber attacks. right? Because that's something that,
That's been going on. That goes
Right,
on
but
every
this-
day. Millions and millions of.
right, but if you don't have the military wherewithal to attack your enemy, then the next logical point of inflicting damage is potentially through cyber attacks.
And I think it also goes to show that, remember, the market dropped almost exactly 20% into mid-April, right? A lot of institutions were forced to sell stocks that we were talking about, and we essentially V-bottomed over 2 months. And a lot of institutions that were forced to sell, haven't been able to reposition back to get their money in the market the way they want to. If you're a big institution, it takes months and months and months to get back into the markets. And when an event like this happens and people exhale, those institutions that thought they had more time to get back in are kind of like forced, because the dip that they thought was coming, 5% or 8% after we rallied 20%, it's not coming. And the next thing you know, it's green. We're almost near the end of the quarter. So you got a lot of people who are like, hey, I'm behind for the quarter. I can't look bad. So they start buying stocks.
So
Into July 4th. Yeah.
There's a lot of money still on the sidelines. I mean, we see it with the amount of money market assets that exist out there that could easily be rolled into the equity markets. And to Chris's point, if you're an institutional fund manager and you've made a bad mistake, you made a mistake and made an emotional decision, and you sold everything during this event, then your job's at risk,
Yeah.
and so you're literally forced to come back in. And so that just brings us back to this whole point that we sort of alluded to earlier. It's like, if you were to ask me, what you did, what did you do that was really right so far this year? It was not making a second mistake, right? By making an emotional decision that a lot of folks did. And now we're actually in the position where we're using that to our advantage, because we know that should, any event, unless it's some major event happen, I think the expectation would be that pullbacks in the market are going to be relatively shallow, just for the reasons that Chris mentioned.
Okay, so we are going to move on to our first raffle for tonight. So, okay, so as a matter of fact, we're not going to move on to the first raffle, because I just got the word that no one signed up for the raffle. So we'll give you this. We'll give you 2 minutes. It's a $100 gift card. And if you want to sign up, maybe you'll be the only one. I don't mind keeping the $100 in my pocket, but if you want to sign up, we're going to have the raffle. We'll give it 2 minutes. The QR code is going to come up. You'll get two things. You'll receive the Retirement Success Plan ebook and also our weekly stock market update. So it's a good opportunity for a quick $100, but I don't mind keeping it myself either. So
I think that $100 would go into the bonus pool for the investment team.
I don't think so either. Okay, guys, I want to talk a little bit about what some of the directions the market could go over the next 6 months, because right now I think a lot of people are starting to feel fairly comfortable. We got this Iran-Israel thing happening. The market went up. We have obviously more geopolitical pressure with Israel and what's going on with Hamas. At the same time, the Russia-Ukraine war is still going on, and the market just shrugs it all off. So geopolitics obviously isn't an overt concern. What is?
I would list my concerns in that wall of worry that folks like to talk about, to slowing growth, economic growth here. Trade and tariff policy is still uncertain. No, a lot of the big deals have not been inked, so until they are, that's still a concern. There's still this federal budget deficit in the tax bill that's rolling through Congress. And you still have the Federal Reserve that concerned that maybe they're late on lowering rates. And I think geopolitical risk has certainly subsided, but I think that leads to the next thing that people start talking about. I'll get back to cyber risk. But then I take that and I'll counter it with the underlying fundamentals, which are that economic growth still remains positive, even with everything that we've talked about. Earnings growth continues positive, even with everything we've talked about. Inflation is falling. and the Fed is in the midst of an easing cycle.
With all of that, why is the Fed not lowering rates? Chris, I know you put a video out about this recently. Inflation's coming down. It is literally, is it at the 2% target? It's darn
No.
close, isn't it, from a growth rate standpoint?
Do you want to know exactly what it is?
Yeah.
The 1 year is, where is the 1 year? The 1 year is like 2.5, the 2 years 2.45.
Okay,
10
so-
years, I mean, but it's in the same range it's been for the last 20 years.
Okay,
Right,
so
so-
inflation's not a concern.
It is to them.
To the
It is to
Fed,
them.
the hinge, the catalyst is that they seem intent on waiting to see if there are any lagged impacts of tariffs and what occurred.
Okay, let's say let's say there is. Is a quarter point rate reduction going to have any meaningful impact on?
No, I'm not saying it's right. I'm
Yeah.
saying this is what they're thinking.
It-
Yeah, they're
on-
they're waiting. They're waiting to see.
Yeah.
They're waiting to see.
On asset inflation, probably, right? If they cut right now a quarter point, stocks
Re-
go
re-
up,
re-
bonds go
re-
down.
Remind me again,
But-
the U.S. economy is how much service oriented?
73 to 75%. yeah,
Okay, so
yeah,
we're talking tariffs on goods,
correct.
which is 25% of our economy.
Yeah, the inflation. I mean, the inflation data in developed countries. That as much as we talk about eggs or cars, it's labor and real estate. It's housing. Housing's coming down. Apartments are coming down, and labor is slowing. The labor rates are not. Hourly rates aren't decreasing, but they're slowing. So those are the main inflation components in the United States, and the Fed is looking at goods inflation.
Is there
which I
something
don't
else
like.
behind the scenes
Don't
that?
know.
Remember, Greenspan said, "If you listen to what I'm saying, what did he say?"
Oh,
I don't recall.
It was a famous saying.
I
He
know
said,
it.
"Yeah,
I can't quote it.
slipping my mind right
Yeah.
now." But basically, the Fed is, outside of President Trump, the most powerful person in the world, and what they say matters. Is it possible that what they're saying is what they feel they need to say to help stabilize maybe what some would consider a destabilizing, mouthpiece, let's say, in the administration? Do they maybe see themselves as trying to perform a balancing act?
This whole game that they play with setting expectations via communications, exactly what you're talking about, is a dangerous game in my mind, and that, I think, is exactly what's going on.
I mean, they're late. I mean, as much as we might not like the president's tact for talking about interest rates, he was right in 2018. The Fed was too tight then. They ended up cutting rates after Trump kind of lambasted. They didn't cut because of Donald Trump, but they cut because the economy was slowing, and Donald Trump is kind of bashing them again. Don't like his tack, but his messaging is correct. Inflation is coming down. They're too tight. They have room to cut. I don't know if Powell runs out of his term in 9 months. Maybe he just doesn't want to make a mistake before he leaves and look bad. I don't know, but they'll cut at the latest September. It sounds like, just even though they met last week and he was quite hawkish, I guess, every governor out the last 2 days has talked about, well, July is an open meeting, we might cut. The real numbers say they should cut, they're fine. Inflation started decelerating in late March like it normally does. It's very seasonal. It might pick up again, but we're not getting into the 70s stagflation run that people are trying to scare others
Sure.
about, right?
Yep.
So it's, we're in the long-term interest rates, 10 years are at the 4.25%, I think 4.3%. Right now it's a little too much inflation, a little too little growth, because people are stuck, wondering about the tariff plan.
Charles, I'm going to give you a second to respond to that. I'm going to, Heather, did we get anyone to sign up for the raffle? Okay, it may be maybe we have some type of breakdown on our end. If you did sign up for the raffle, I'm sorry, it's not showing that we do have anyone signed up. So if you did, I apologize. And if you didn't, then that's fine. You're gonna have one more chance. We'll have an opportunity Patrick, I needed the comments pulled back up there. Thank you. Oh, awesome. Okay, so we're going to, so everyone, I don't know if you can see Patrick right here. Everyone say hello to Patrick. He's our intern. Every time we do an event, I try to introduce Patrick. He's very shy, but should not be. Okay, so
maybe just to finish that thought up in terms of sort of, you know, we listed the concerns, the wall of worry that markets like to try and climb, what's going right, I always like to get back to, so what are we doing, right, for in our portfolios for our clients? We're, I say, you know, packing them full of growth as much as we can, tilting them slightly towards more economically sensitive areas of the economy.
what does that mean, economically sensitive?
Industrials, firms who, large industrial companies who build air conditioning equipment for large data centers. That's a huge thematic trend. The AI trade.
Should we get into quantum computing?
We're into quantum computing. You know, it's not all about just zeros and ones. You need to be able to enter a state using qubits where you can actually participate simultaneously along that spectrum to massively increase the speed of computing.
And it's really going to change industry.
It is a whole thing unto itself.
And those
right
computers are going to need to be cooled. So going back
now.
to,
You know, that stuff runs hot.
Yeah.
You're going to have
And
to cool them.
this is the interesting part as far as looking at the it's not your grandmother's or your grandfather's stock market anymore, as far as
It's
the
not.
companies that are out there that you have to actually understand and be able to follow. And when you guys listen to the conference calls, you have to know what's going on, right?
That's a great, I mean, it's a great point. It's not even, I hate to say this, it's not even Charles and my bull market, right? It's Gen Z, it's millennials bull market, in that, you know, when Charles and I, 20 years ago, 30 years ago, it was the build out of .com, right? And now it's the build out of AI and quantum computing, right? And so by the time it's built out, you know, and really immersed in society and stuff, it's gonna be another 10 years, 20 years before everything is really gelled together. But now is where all the investment is taking place.
Let me pose this to you. So let's call it 10, 20 years for the .com bubble, or excuse me, not the bubble, but the .com, everything to come together. But with AI, and especially now with quantum computing, can't we just ask the computers how to make it come together a little bit more quickly? And maybe it's not 10 to 20 years. Maybe it's 2 to 3.
You haven't
accelerated
had to ask them,
computing.
but for like as Chris was saying, is we've all become more technologically savvy. The uptake of things such as AI are monumentally faster than things like even streaming, right?
Yeah.
You want to feel old? Take a look at a chart to see how long it took for
Netflix.
Netflix to get to 100 million subscribers. Then take a look and see how long it took for OpenAI, you know, to get to 100 million users. It was like overnight for AI.
And what's interesting is, again, this is the definition of our process, right?
Yeah.
Identifying companies that have exploding sales, exploding margins, and return on invested capital. So what return on invested capital means is you have a management team that takes profits, and they have to decide, what are they going to do with those profits? They can pay dividends, they can expand with capital expenditures, they can reinvest into the most profitable departments within the corporation, or any number of other things. We want companies that are taking those dollars and investing into the most profitable components of their business to create this compounding effect of cash on cash on cash, and that's how you get stock price explosion.
One thing I wanted to point out, because Chris and I were so fortunate, we were in a very privileged position previously when we were at Invesco, to have seen every single company or any company that we wanted to that was doing an IPO back in the internet day and into the internet bubble. And so we had a front row seat. We financed who we wanted to and who we didn't want to. We basically disintermediated a large section of the banking system, and to identify winners and losers in there. That was an interesting insight to have, to be able to bring to bear to what's going on now. A lot of people don't. have that. The other thing I'd point out is that for myself, like when I worked for a brief time as a consultant for PricewaterhouseCoopers, I was working in a group that was identifying, working with venture capital and private equity to identify where the next big things were. And so for me, one of the things I look at every day is what's going on in the venture capital community, what's coming down the pipeline that's not even a public company yet, so that we can be aware of some of these trends that are emerging. And that to me is just a part of what we do on a regular basis in looking at the companies that are public, their customers, their competitors and suppliers, what are they saying? But we do take a look and see what's coming down the pipe.
Chris, I'll give you a second because you ran a small cap fund in San Francisco.
Oh, geez.
In the
That's why I came back to work with Charles.
talk about stressful, I imagine.
Oh my God.
So I read something today with the Circle debacle, not debacle, that's an overstatement, but down 15, 20% today. So I think 15, 16%. Not a big deal. It's up
fivefold in 2 weeks.
Yeah. Point being, though, what I read was that stable coins now settle more transactions than I think Visa and MasterCard combined.
Wow.
I think I've read that too. I don't think that's true here in the United States. I think it might be true
Globally,
I believe,
right?
So.
Yeah,
Yeah, because there's a lot of other countries and stuff that don't have the financial system that we do.
But JP Morgan's looking into it. I believe Goldman's looking into it.
Walmart,
Amazon. It just kind of got me thinking here. It's just, this is a wave of, it's the new future. It really, truly is. And it's happening so quick. I mean, when I read that today, you think of Visa and MasterCard, legacy companies that have been literally settling transactions across the globe for what, 50 years?
Sure.
And now all of a sudden the advent of something called a stable coin which is just it's a digital currency. It's a one-to-one relationship with the US dollar, but it's digital. It's faster, it's cheaper, it's, I believe, more private. Settling more transactions than Visa and MasterCard combined. This is a new world. So
I mean, it is. Yeah. I mean, I'm going to try to bring this back to, kind of the second half outlook and what I think you're talking about. What could go? You usually ask, well, what can go right? What can go wrong? Right. And one of the things that can go right, not only for the second half, but really for 2026, it's kind of the candy. It's the things that we thought President Trump was going to do, when he entered office, and he's pushed out closer to the second half of this year. It's deregulation, whether it's on the financial markets or banks. It's tax changes, whether it's accelerated depreciation, which doesn't sound like a big deal.
It's a huge deal.
It's a massive
It's a
deal,
big.
particularly when it comes to technology, because and yes, it's somewhat accounting, but if you can put the cash out the door and depreciate the CapEx quickly, it doesn't hurt your earnings next year, right? And you can get the revenue growth from the investment without the hit to earnings. Yes, the cash is out the door, but you don't get the financial hit in 2026. And it is a big deal for all these companies that are investing in AI, billions and billions of dollars, which I know the talk, 6 months ago, 3 months ago, 9 months ago was AI's peaked, right? It's if anything, it's probably mid-cycle, like it was in .com in 1998. Yeah.
It's interesting because you talk about mid-cycle. Honestly, we could still be. We've went through this kind of exhilarating phase to where NVIDIA and Palantir are just kind of through the roof. But really, is it not just in its infancy as far as the capabilities and what could be next, could be next?
Totally. I mean, the stock NVIDIA is flat for the last year. NVIDIA peaked in, I think, July 3rd through 8th of last year.
But it's been an up and down flat.
Went down to like 80 or 90.
Point to point, it's flat,
right?
but
Palantir is up
140
like
to 105.
It is, but AI is still growing. The AI investment cycle is still, instead of 120%, it might be 40 to 60%, and that deceleration is what you've been compressing the PE for NVIDIA and all these other semiconductor companies. But now people are seeing this investment is going to last at least another year, maybe another 18 months or 24 months at very high rates. So that's why the semiconductor companies have kind of picked up since mid-April.
We used to always say sometimes these companies have to sort of grow into their PE multiples, and that takes time, right? It takes time. And so now we've hit another point where we believe there's a positive inflection. And I'm pretty sure that Heather needs us because the
winner.
bonus pool may be depleted by $100 as somebody may have won the raffle. Oh, no.
Flip a coin.
Bruce Brown, you are tonight's winner. So it's pretty easy, probably the easiest $100 you'll ever win in your life. So Bruce, we're going to reach out to you. You're going to receive a $100 gift card. Way to take advantage of that opportunity, which really, guys, it's what you do. You take advantage of opportunities. You know,
right.
that was a stock selling at like $1 that we expected to go to 100. So Bruce, good job taking advantage of that opportunity. And we're going to reach out to you to get you that gift card. So
I like it.
it was. It's basically exactly what it is.
Did there. It's good.
Okay, so let me check the comments here, see if we have any questions. And then we're going to transition more into, link for the raffle wasn't working. Okay, so that's what happened.
It's that cyber attack from Iran trying
That's
to take
what
our
it
$100
was,
bucks.
yeah.
Oh my God, I woke up this morning and it was crazy. So I have Xfinity at the house and I have T-Mobile on my phone. Both of them were not working. You know where my brain goes.
Right.
Immediately I'm like, oh, some type of dirty bomb, some type of cyber attack. How is Xfinity and T-Mobile both not working? Okay, Mark says, how does the M&A market look for the rest of the year? Does tariff policies influence foreign regulatory approval for U.S. company-driven deals?
That's a good question.
Yeah, I think kind of two different things as it relates
deep
to
question.
the approval of regulatory deals. I think we would all believe that we're going to be in a more favorable regulatory environment for M&A activity to occur. I think that's the case. You just need something to catalyze it usually, and we've seen. There's been a lot of, we would always call them take-private deals, things that you don't necessarily see in public markets. But we actually have, one of the reasons that we shifted down a little bit in market cap is that some of these smaller, mid and large cap companies become very attractive acquisition candidates with depressed valuations like we were seeing. And we're beginning to see a pickup in some of that. We're having companies that we see them pulling up trial balloons, right? You'll see in the Wall Street. We saw one the other day, right? Just as an example, right? Northern Trust, somebody says, well, Bank of New York had a conversation with Northern Trust. And that's probably just, investment bankers providing a trial balloon to see what the market's reaction would be to a deal like that. And so it's been a while. There's certainly, I think, a backlog of that sort of activity that would like to occur. I think what I would see and what we would see from the consulting side is that company managements really needed to be sitting on ready. And obviously the V bottom that Chris refers to, the big pullback we did, it just happened so dang quick that corporates couldn't pull the trigger that quick. We find that things that had impeded the ability for the large investment banks and others to finance these types of transactions, those barriers no longer exist. And so the skids are greased, and we're just sort of waiting for that sort of activity to occur. I think it's going to happen.
To directly answer your question, I mean, that's a great question. I've never already thought of it in those terms, but to answer your question in my thoughts, yes, tariff policies will affect the outlook for foreign governments approving mergers because they're bureaucrats, right? And if they have a PowerPoint that they can hold over the U.S. in a negotiation, they'll use it. China has used denying mergers, over the last 2 or 3 years. So, great point. I don't think it's going to be that big of a deal on the tariff side with regards to stopping mergers, but hadn't thought of it. But yes, it could slow them.
Well, let's get into this because we had a pre-submitted question. We had a pre-submitted question from Gary. Gary, it's a long question. I'm not gonna repeat it kind of verbatim here, but he says he's seen a negative impact himself from tariffs, but they've not yet come to fruition within the economy. He says, when will they, if they will, come to fruition? Kind of piggybacking on what we just talked about regarding the Fed, you know, how long possibly is the protracted delay of the tariff policy? And we've said since the beginning, it's maybe not the tariffs themselves that are a concern, but the threat of larger tariffs that the markets are more concerned with. But what are we looking at here? Because we're moving into the second half of the year. We still have some uncertainty, although it's been pretty clear that President Trump has used tariffs as a negotiating tactic to start to get people to the table to create more trade deals. But at the same time, he's a wild card. He very well could impose some type of pretty heavy tariff that disrupts global commerce. And at the same time, maybe it's just a tactic. So where are we at? How do you guys see this playing out? And I guess more importantly, if we were to kind of look at probability-wise, the overall impact that it could have on the second half of 2025.
I mean, this gets back to our economy is 70 to 75% service economy. So, and remember, listen, anyone who's affected by tariffs in their business or home life, I feel for you, right? But our job as an investment manager is to not feel as much as it is to say, you know, are the tariffs going to hurt the stock market or your investments? And the stock market right now it's got to be 50% technology and telecom services, Google, Facebook, those Meta. Tariffs aren't going to do anything largely to Meta or to Netflix or you know, these kind of companies. So now you're whittled down. You just got rid of 50% of the S&P 500, and you start going down. You look at retail. Well, it's going to affect Walmart and Costco. Well, Costco makes all their money generally on memberships. Is a higher tariff going to cause you not to shop at Costco? No, it's probably going to make other people sign up because their prices are so low. It's going to make people go to Walmart. So as a portfolio manager, you know, our job is to basically be a filter and say, I don't like tariffs, right? They're a tax. They're a tax on someone in the U.S. economy. We have to figure out where that friction is going to hit, how much it's going to hit, and we try to stay away from it. You know, if it's going to hit a certain area hard, whether it's autos or retail, you know, where their costs.
There's a marginal impact. Certain companies, certain industries are marginally impacted more than others. And as investment managers, it's your job to identify those companies, de-risk as far as portfolio management is concerned from where risk is increased, and take advantage of the opportunities that it creates. Because anytime someone is hurt in a capital-based economy, it creates an opportunity for somebody else.
Agreed, and you know the only way to do that is by being an active manager. Because if you're investing in an S&P 500 index, every dollar you give is being allocated to all 500, actually it's 503 right now, of those companies. So that's sort of a complete misallocation of capital, but you're exactly right. The other thing to keep in mind, in addition to what Chris said, which is just spot on, is that in last quarter's earnings conference calls, company managements provided forward guidance that included tariff rates which were as extreme or as high as possible. So now, to the extent, and analysts accordingly,
and those stock prices came down.
And analysts lowered, and the analysts all lowered all their earnings estimates. So to the extent that tariff rates aren't as high as the sort of extreme high level or potential, which they shouldn't be, then there's potentially upside to earnings estimates.
More opportunities.
Yeah, it's one of the weirdest things that took me forever to learn in the stock market. Less bad is good enough, right? If, you know, a -10 going to -8, that stock probably is going to be great relative to a +20 going to a +15.
Because
right?
it's the marginal return.
Marginal return.
Capital.
Exactly. Like, and it, you know, when companies fire, you know, 5,000 employees, why does their stock go up? Listen, I hate, you know, I've been fired before in my career 2 or 3 times. Hated it. Felt horrible. But you know, if you're a shareholder at one of those companies, there's more money now for the shareholder, more money for the management to then hopefully reallocate in more money-making ways. So it's, you know, you're trying to be unemotional with your dollars. I mean, it's your money we're investing. We're stewards of your capital. So try to take the emotions out. And you know, sometimes it's difficult. I mean, these guys will hear me in the back. You know, when the president decides instead of 10% tariffs, it's going to be 135 with some strange, chart that one of his assistants
Use the
throws out.
crayon to,
Yeah, I mean
to
that's
drop,
and that's why
yeah.
the market dropped 10% in 5 days, is because no one had any idea that was coming and how they came up with the number. But the market also bottomed when he started walking it back because it was event driven. It was totally.
And well, that's
of
the one
DC.
thing that when you talk about the President Trump playbook, it's, wield the hammer and then come with the carrot. It's kind of opposite from, Teddy Roosevelt, right?
But it wasn't in 2017.
guess
That,
not.
and
It's kinda
that's-
similar in
that
a
was
way,
the
but just-
different, right?
yeah. So, look, we figured this much out, and going back to what we talked about at the beginning of this segment, if you had a President Trump playbook at the beginning of this year, hey, that playbook got completely upended, and the administration came with the heavy-handed stuff for the first half of this year, as opposed to what they did in the first half of the first term of the administration. So things have been upended, and it was important to be flexible, to be nimble, to be able to take advantage of the changing policy expectations, and also just the day-to-day changing policy positions. And before we kind of wrap up the second half outlook, I think one of the biggest takeaways moving forward is the significance of understanding and the importance of being nimble every quarter moving forward, because this is not an administration that is here to play around. They are convicted on their agenda. I believe they've had 4 years to lay it out. Trump has his people in place. He has more experience. And the one thing I know for certain is that whatever Trump says, he says intentionally, and he says it to kind of get you looking over here. But what he's really doing, he's bobbing and weaving, or zigging and zagging, or jabbing and uppercutting, whatever you want to call it. But whatever this man says, there's an intended purpose. I don't think it's just from the hip. I think it's far more strategic. And he's always kind of doing something over here, which is the real agenda. So he says something, markets react, and he's really kind of pushing forward over here. 50% tariffs. Well, let's negotiate. Let's get you to the table, and let's do this. We may not bomb. We may bomb. We drop the bomb. Here's the goal. Peace in 12 days. Peace, air quotes. We're not sure how that's going to play out. And I could be completely wrong. I don't know, but it does seem like there's a pattern or a trend here that it's bombastic, it's out there, it's a look over here world, while really they're trying to accomplish something else, and this is their tactic to accomplish what they're trying to do. So again, active management, being nimble, is kind of the theme here, right?
Sure. You made me think of a couple of things. Another metaphor, perhaps. The other thing you were talking about bobbing and weaving, but it also made me think about Mike Tyson, who said that everybody's got a plan until they get punched in the face.
Especially by Mike Tyson.
Especially by Mike Tyson. So I've always thought about that. It's like, well, you better learn. We've been doing this for a long time, and if you get punched in the face enough times, you learn when it's time to duck. And so hopefully we do a good job of ducking every once in a while.
And just setting up your defenses, right?
Yeah,
This is where a lot of the hedging strategies that we're able to employ come in quite handy during a time like this, because when you identify good companies, but there's this thing in the middle called market risk, the ability to hedge out that market risk to an extent to help reduce volatility, especially in retirement, can be to our advantage.
You're right where I was headed, because everything that we've described and talked about creates an opportunity set that allows an active manager, if they have the platform to execute upon it, to identify these really, what we believe to be these really good stocks. And then, like you said, it's for every beneficiary or something, a lot of times there's somebody that's on the other side of that gets penalized, right? So if you can express either a positive view, or now actually open up your opportunity set to express a negative view on a stock and say, this is where I'm going to embed my risk as a stock picker using those attributes you described. But if I can create a structure that allows me to hedge out some of what I can't control, which is that overall market risk, then we've created a very interesting product structure, which we've done, and we have that strategy in place, and it is exactly what Chris and I and Dwayne did as a core team at Invesco back in the day to create a product that, if done, executed properly, can take advantage of all of the attributes of active management, and if done properly, mitigate as much or as little of that systematic market risk as we deem prudent.
And very happy with how things have kind of played out for this year as far as the ability to utilize a lot of that technique and strategy to, it's not always going to be perfect, right?
Exactly.
But very, very happy with how we've been able to have a tool at a time of, let's call it extreme uncertainty, but at the same time, growth. Like the stock market is growing, so to be able to grow with less risk, I think is what every person in retirement or approaching retirement is really looking for, because our job as a retirement planning firm, as someone who focuses on not only investment management, but the income and the tax planning, is to protect first and foremost our clients' retirement dollars. So very happy to be able to have the capability to hedge out some of that market risk and still take advantage of growth opportunities as they not just take advantage, but do a really good job taking advantage.
Agreed. And it's like, our job is to build the best possible product our advisors can use to meet the needs of our clients. And so this was a natural extension of what we did. We have a very solid growth product. We have a very solid dividend growth product. And then this was an avenue that allowed us to create something that allows someone to get invested and stay invested without, hopefully all of the worries of the volatility. And sometimes it's going to work really well. And sometimes if markets are just headed generally straight up with zero volatility, it's not going to do as well. But that's why,
That's why you stay diversified.
Exactly. Yep.
Okay, Chris, so let's kind of start to refocus before we do our last raffle for the night. I see you're doing some math over here. What are you doing?
I was
Chris brought real quick. I believe this is the same calculator like 6 years ago. Chris brought.
No, that's the same calculator I had in college.
The interview that whenever I interviewed Chris, I said, "Why did you bring this calculator?" And he started just pushing out calculations. And you told me
that's a New Jersey phone number, so that's 1988.
Yeah, you told me that was the calculator you had since college.
Yeah.
So undergrad at Georgia Tech.
That's undergrad at Georgia Tech, yeah, and then right out of Georgia Tech. So I was just Charles likes to talk multiples on PEs, and I've had a lot of people ask me for the last 2 months or whatever, hey, have you changed your mind? Have you changed your forecast where you thought the stock market was going to go? How could you not do that? I'm like, I still get the same number for the end of the year, beginning of next year, which was 6,600. It hasn't changed. Market went down to 5,000. We're now back at 6,100. I get there all the different ways. People are like, oh, the multiple's too high on the S&P. What I was doing was, just what I learned early on is the old timers used to take the 10-year yield and flip it over, right? And that's your PE. So right now the 10-year yield is yielding 4.3%. That would be a 23.25 PE. We're supposed to earn $2.75 this year. That would be
$275.
Thank you very much. $275. You multiply those two together, you get about 6,500, right? I think interest rates are going down, not up, and I think earnings are higher than 275, not lower, and you get 6,600 still at the end of the year. Now, is it going to be a straight path? Normally, no, right? We should get a summer sell-off. Probably takes us back to flat, which is, we were discussing this, is only down 2 or 3% from here. Maybe it's down 5% from a summer high, but that's what I was working on.
So we were talking before this, and Chris, you had said, and gosh, I've heard you say this for many years, and it's funny how patterns repeat, but you were saying if you didn't know who President Trump was and you didn't have any expectation coming into this year, and you just strictly looked at what's
presidential cycles,
that it's honestly
you would have killed it.
There's not that much different this year than any other first year in a presidential cycle.
Yeah.
So first term, first 6 months in a president's term.
Yeah, I'm kind of embarrassed because I'm the one for 7 years like, hey, it doesn't matter that much who's president, right? The economy's bigger than the president. It'll do what it wants to do. With
But
the
Trump
Fed
is such
and
a
stuff.
polarizing and
Yeah.
in many ways kind of just change figure, right?
Well, and he threw us a curveball, right? He didn't give us the carrot at first, like he did in 2017. He gave us the stick, right? And no one was ready for the hammer that came on Liberation Day, including ourselves. And so, but we didn't panic, and we didn't panic for our clients. We didn't panic in our fund, and the returns I think are showing that, and the outcomes are, and the economy's doing okay. It's not great, but it doesn't have to be great.
No.
Right? It just has to be
The stock
stable
market
and
doesn't
shut-
want great.
It doesn't. And euphoria is
Stock market
fun.
wants modest and stable.
Yeah, euphoria is fun for about 9 months, and then you lose your hair because it goes away, right? I mean, .com was then 12 years of sideways. I think that's
Just
about right.
about,
2000
yeah.
was the peak, and it took to 2012 to get back there, right? So,
So you feel confident. I shouldn't say confident. You feel comfortable that it's going to be kind of volatile, as it always is, into summer. And there's a decent opportunity. We could end up the year 65, 66, maybe 6,700 on the S&P, which is, let's call it 8 to 10% higher than where we are today.
yeah, something like that.
The better question would be from an active management standpoint, and we don't have time to get into this, but just because the S&P maybe is up 8 to 10%, there's going to be companies in the S&P 500 that do a lot better, and there's going to be companies in the S&P 500 that do a lot worse. So that's where it really comes down to identifying growing sales, expanding margins, return on invested capital, SMR. Like, I just want to sit here and cheer it out. SMR. SMR, because when you understand the fundamental drivers of a stock prices of movement upwards, it's sales margins and return on invested capital. And when you have accelerating growth rates, not just the growth rates, but it's the acceleration, that third derivative, it's the acceleration of the growth rate, it's the rate of growth. When you have that, that's when you start to experience this NVIDIA, the Palantir, and really what we don't have time to kind of get into this. Maybe next time. Some of the companies, though, yes, the S&P may do 6, 7, 8, 9, 10% from here. Some companies are going to do a lot worse. Some companies are going to do a lot better. And allocating that capital across those companies, that's the name of the game here.
Right. And one of the things I'd say is that too, that, it sounds simplistic and we try and keep it simplistic, but when you think about in practicality how you actually do that, it's a hell of a lot of work. It's a whole lot easier. The easiest job in the world, be an index fund manager, right? Somebody gives you a spreadsheet at the end of the day and says you got
don't do anything.
$10 million, here's the allocation, right?
Literally, like the garbage truck guy could be an index manager, right?
If he can work a spreadsheet, yep, you're right.
Hey,
So,
And I want to say something, and it's honestly, it's kind of a confession, and you brought it up, but I learned it again, and Charles knows this, probably what I'm talking about. On the SMR, the sales growth is great, but what the market really likes is margin expansion, right? It's margins expansion. And I don't know how many conference calls I listened to last quarter where you got a tech company, they would just blow out revenue and their margins would go down 0.5%. The stock would open up 5% and it would be down 7% in the next 2 hours. And it was immediately, as they said, our margins will be down next quarter. The stock went from up 5 or 6% to down. Now, most of those companies have recovered because their revenue growth is kicking in, but it's the margin expansion. It's because
Palantir is a great example, right? NVIDIA too.
NVIDIA
right?
is a great example because it's gone nowhere for a year because they had a product cycle. The revenue's still growing, but their margins are
70%, 75%, and coming down.
and coming down because they went to Blackwell from whatever their previous one was.
Hopper,
Hopper, that was it. And now Blackwell's kicking in and ramping, and the stock's recovered from 80, 90 back to 145.
But it's
and
not
if
because the margins have necessarily expanded, it's because they're anticipated to expand.
they stopped going down.
They stopped
right?
going
and
down.
if you find a company that
Which
the
is a
margins,
classic reversal.
it is.
That's
Or
it.
if inventory is high and starts going down.
That next earnings
that's it.
report, it seems like every NVIDIA earnings report is the most, critical earnings
sort of
report
become
in
that
the history
way,
of the
yeah.
stock market.
Yeah.
But to your point, so I talked to you guys a couple weeks ago. I was like, we had some divergence from what the market was doing versus kind of how some of the things we're running were doing. And you said, hey man, sometimes when you're ahead of where things are, you expect this. And goes back to your sales comment, because what's the leading indicator for margin expansion? Sales growth, right? If you don't have a good product, you can't have higher sales. If you don't have higher sales, you cannot increase your price.
Right.
And if you do not increase your price, you cannot have expanding margins. So there's multiple ways to look at this. Your point is absolutely correct, that margin expansion is what drives growth rates and drives stock prices. But a leading indicator a lot of times is that sales growth. When you're trying to get ahead of the curve, look, if it was just as simple as identifying companies that are growing margins,
Yeah.
we'd all be doing the same thing, and we'd
Right.
all be,
Dwayne would
index
be running
investors.
everything that we
Yeah.
do,
Yeah.
right?
Yeah,
Because
yeah.
it would be purely quant. One of the things that we talk about is that we identify these criteria using a quantitative approach, but then it's incumbent upon us as fundamental analysts and portfolio managers to determine, is it sustainable? Is it durable?
Yeah,
Right?
durable.
Because if it's
That's
not,
the key word, durable.
If it's not, if it's just a one-time event, the market's not going to pay anything.
And is
for
the
that.
management team capable of replicating those results?
Right.
Right. Or is the product itself, can it be, replicated elsewhere
Right,
in
yeah,
the
it just
marketplace?
become a commodity,
Right.
and then
Is it
its
a
value? Yeah.
So durable is the word, and
Yeah.
that's where NVIDIA, for example,
Mhm.
has really set itself apart, because not only is it proven to be durable, but it's proven to be transformative.
Mhm.
In regards to the technology that it's brought to the marketplace, and allowed other companies to increase sales, expand
Right.
margins,
Well,
and
that's why I love being when possible, being a thematic investor and identifying long-term secular trends. Makes our job a whole lot easier, right? Because we're not things are not constantly changing. If it is durable, then you can own a stock for an extended period of time, and you're not constantly trying to juggle around. Where's the next one? Where's the next one?
I want to give
Yeah, sorry, I
no, that's
interrupted
okay.
you.
One other hint: if you're doing this by yourself at home, right? If you're doing research, if you're looking at balance sheets and income statements, you're probably really bored. But like Charles and I, but if you want a hint, one of the leading indicators, probably the best one, is if you look at inventory relative to sales, right? And all you have to see is inventory not growing as fast as sales. And it's one of the best indicators of a company turning. And if you want to get out of a stock, if you start seeing inventory building faster than sales, and management saying, hey, we got this great opportunity, and we're building inventory, but you don't see their sales growing as fast, the stock, it may go up, but it's more than likely not going to outperform the S&P, because all that inventory to investors is risk, right? If you're growing inventory faster than sales, that's just risk that down the line you're going to
it's
have to
either
cut.
risk or poor management.
You're going to have to cut pricing on all
Or
that
to
inventory to
either-
get rid of it.
quality of product.
Either way,
It's-
it makes for a bad stock, and that's
Right. Bad
why
stock.
that's
That's
why
right.
we're layering in what I refer to as forensic accounting screens
Yep.
to identify. Use a computer, use your computing horsepower to identify these companies where these trends are emerging.
Right. Whether you have too many stretchy pants or
right or whatever it might be. Or,
And
or
it's
semiconductor
it's,
chips.
it's an interesting point. So for a long time, one of the questions earlier talked about AI and trading, and I didn't bring it up because no, the simple answer is AI is not going to replace human traders anytime soon, because where AI is going to be helpful for those that know how to use it is, to Charles's point, you have to be able to ask it the right questions. And what you just brought up and what you expanded upon, I mean, I've been doing this a long time, sitting with a lot of self-directors, people who've managed their own money for a long time. And it's what you guys just talked about was so far beyond the understanding of any self-director that I've ever come across, and I'm talking thousands of people. If you have the data readily available, you can upload it to the artificial intelligence, and then you have the experience to ask it the right questions, so it can then perform the analysis and create an output, which then you can use your human experience and expertise to go through and ascertain what are the possible choices and then determine what is the best course of action on the information that I have. That's where AI will be useful in the investment world. But you have to have the people who, one, have the data set across whatever particular piece that you're analyzing, but then they have the experience to ask the right questions and then use that computing power to create an output that allows you as an investment manager to make better decisions.
You know what else is interesting? I think is we won't go too far down this rabbit hole because you've introduced a whole another.
It's a whole nother
live
podcast.
We utilize the Bloomberg platform as our primary market data provider, and they do a lot of interesting things. And one of their big avenues is being how to use AI and something else called alternative data. And you know, it's your information on your credit card usage is collected, and they don't know that it's Troy Sharp or Chris Paris. It's collected. It's called metadata, right? So it's nameless, faceless data, but it becomes very accurate. And so there are a number of instances where we can now go in and identify the amount, number of transactions and the dollar value of credit card transactions for certain companies that are very much, have a very large portion of their businesses online based. And so we can see how companies' business, like a restaurant, if you will, what...
Say Darden, for example.
From various data sources that track this data, foot traffic, ticket price, ticket, number of items, the amount of data is phenomenal. And so now we can keep track of how that data is going during a quarter versus where analysts' expectations are. And we use that. A lot of times, I'm finding it to be pretty effective in our mutual fund product where we can go short stocks. And it's like panning for gold.
So what we want to do to wrap this up is, one, I haven't checked the comments recently to see if there are any questions, but any final questions, we want to give you the opportunity to go ahead and post them. We'll discuss them for a couple of minutes. We are going to do the final raffle as well. So we have, I'm sorry, I'm trying to catch up here. Well, Louise, I have the 1974 HP. Fast Eddie says, my Magic 8 Ball tells me everything I need to know. So I believe, Fast Eddie, that goes back to like a pod or a live stream like a year ago, I believe we were talking about that. Okay, so guys, we'll throw it to Charles. Chris, we kind of got your prediction, 65, 66, 6,700. Not a prediction,
yeah, it's just,
but a
it
possible.
hasn't changed.
Yeah, it hasn't
Yeah,
changed.
It hasn't changed.
If you have any final questions, go ahead and throw them in. We're going to toss it to Charles. We're going to come back to the raffle, the second raffle winner, and then any questions we're going to address, and then we're going to wrap it up for tonight. So, Charles, any final kind of thoughts as far as the second half of 2025?
Yeah, I'm on board precisely with the way Chris came about. Sort of that number is the best efforts, given what we know today. But my approach a lot of times is a little bit different, which is, I think, is a good thing. And that my perspective is to be a good investor, I have to continuously be intellectually curious and open to new information and not afraid to pivot. And that's what I focus on every day. And I just love coming in and rolling up my sleeves and just putting the hammer down every day.
And it's a great lesson just for life in general, because I don't know if there's another job. I'm sure there is somewhere, like being a surgeon maybe comes to mind.
Formula One race car driver.
Formula One, to where
I knew that was coming.
well, I was going to say where you can literally get punched in the mouth. Boxing obviously, but that's literal.
Yeah.
Where you can make all the best decisions based on the best information and still get punched in the mouth.
Yeah.
And you just have to do it day in, day out, and day in and day out, and you have to create this leathery skin that allows you to have this positive outlook, but also believe powerfully in that what I'm doing is the correct formula for identifying companies that have the opportunity to grow. And when we combine these companies together, I believe this is creating less risk and more opportunity for growth. And of course, we have the analytical tools to help support that. But to get punched in the mouth, day after day, year after year, honestly, I need to bring someone in here and give you guys a psych eval because
That's what the hedge funds do.
Yeah.
The hedge funds have a
Yeah.
psychologist on staff. Yeah.
It takes a certain mentality. I never take it personally when it's a mistake.
you can't tell me never.
No, I never
because-
take
Nah,
it
he's
personally.
he's he's
I-
better. He's better at
Earlier,
that than
earlier in
me.
your career,
No, I got over it pretty quick.
but you took
I'm-
it personally initially. It's hard not to.
Not for very long, because if you do, you won't survive.
Yeah.
You
Yeah.
can't survive.
No, I know.
Right. I mean,
This is why most people,
people
are
lie to
ill-equipped
you,
to
you
actually
get
manage
hurt.
their
Yeah,
own
I
money
mean,
in retirement.
Ted Bauer come in, walk the floor, and say, you look around at us and say, this is a young man's game, because you just can't take this for so long. You have to, either you have
Because be fearless.
either you have to be too dumb to know better, or just be fearless. And to my mind, I think experience teaches you how to judge, how to manage risk, how to if you ask me what do I do well, is manage volatility and take a very probabilistic approach to how I trade. What's the risk reward? And I know that if the batting average is good, I'll win, right? And I don't have to hit a home run every time. Sometimes you win by letting everybody else lose.
Yeah. Sometimes you win by, letting the pitcher throw wild a
Or
few
by
times.
walking.
That's right,
Yeah.
getting hit by the pitch.
All right, so we have no more questions. Let's go to the raffle, and then let's call this thing a wrap.
They all put it in.
Uh,
Robert Leschman.
Okay, guys, so really sorry about the initial raffle problems that we have, but we do have our second winner. Apparently, everyone who signed up previously and now post has an opportunity. So the good news is we have one winner. The better news is all of you will receive the weekly stock market updates and our retirement success plan ebook. So the winner is it Robert Lushbaum? That's being conveyed over to me. I apologize if I'm pronouncing that incorrectly, but Robert, you are the winner. So our marketing department will reach out to you with a $100 gift card to your favorite restaurant. Guys, this has been a really good live stream. I think we covered a ton of content. Corinne, love the new setup. I think this is good. Guys, send us an email, reach out to us, make a comment afterwards, let us know what you thought about the new setup. For those of you who follow us often, we're typically over here. We have, the background a little bit different. Here we have the round table, we have the microphones. So how was the sound? How was the quality? How was everything? Let us know. I think our team here is doing a great job making some adjustments and changes and trying to improve the content quality that we deliver to you. So as always, we appreciate all of you that are clients. If you're not a client and you'd like us to help you, feel free to reach out to us. Otherwise, we look forward to seeing you next month, and thank you very much for tuning in to the Oak Harvest Financial Group second half 2025 Stock Market Outlook.